You won't be surprised to hear that we also spent time discussing what's happening in the housing market. The pandemic has led to some unique circumstances. With so many households working and studying at home, we see many people wanting more space. And interest rates have been unusually low, making borrowing more affordable. While the resulting house price increases are rooted in fundamentals, we are seeing signs of extrapolative expectations and speculative behavior. Given elevated levels of household debt and the risks that households may overstretch in the face of rising housing prices, we welcome the recent proposal by the Superintendent of Financial Institutions to introduce a fixed floor to the minimum qualifying rate for uninsured mortgages. New measures just announced in the federal budget will also be helpful. We are watching developments in the housing market very closely, and we'll have more to say on this in our financial system review in May. The Governing Council also spent time discussing estimates of the amount of slack in the economy and the outlook for potential growth. While the economy, with the economy.
Thank you. And just to follow up, if I may, please, you made some comments about the housing market earlier and some of the price pressures there. Could you expand on that a little bit more? Are you saying that enough has been done with the recent proposal for more stringent stress tests for borrowers?
Well, first of all, I want to say that we understand that how difficult it is for some Canadians to break into the housing market. And if I need any reminder, I can tell you the correspondences I'm receiving from Canadians highlight the difficulties some Canadians are having in getting the home they are hoping for. With respect to the housing market, I think it's important to first of all reflect on there are many very unique features of the current cycle, and one of them is that we're all working at home. Our children are studying at home. Most of our recreation is at home. People want more space, and they're not commuting to work, and they expect that working arrangements are going to be more flexible going forward. They don't need to be as close to the city center. And so what we're seeing is strong demand for single-family homes, particularly outside of in suburbs and in communities surrounding the larger cities. That's real fundamental demand, and supply is not responding nearly as quickly as demand, and so you're starting to we've seen rapid price increases. Our worry is that against a background of rapid price increases, people will extrapolate. They'll expect that those price increases will continue indefinitely, and they'll overstretch to buy houses. That would be a mistake. The proposal by OSFI to revise the B20 guidelines and put in place a minimum floor on the benchmark. That is a helpful proposal, and the reality is when interest rates are unusually low, there is greater potential for them to eventually rise, and so by putting in this minimum, that will help protect borrowers and lenders from overstretching. There's also a measure announced in the federal budget to put a 1% tax on vacant homes owned by foreigners. Again, that will tend to reduce speculation, and to the extent that foreigners are buying homes as an investment, it'll encourage them to rent those out, so that that will contribute to the supply in the market. Those homes are not taken out of the market effectively. So those are helpful measures. What I can tell you is a couple of weeks ago we put out some analysis of the housing market and the associated vulnerabilities. We will be putting out more analysis in our May financial system review.
Next question is from Greg Quinn of Market News.
Good morning. I want to amplify the question on housing a bit. People have cited not just the pandemic, but low for long interest rates as driving up home prices. Does the Bank of Canada not need to do anything here to help prevent any of the dangers in mortgage markets and housing markets?
Greg, I mean, look, there's no question, Greg, that low interest rates have made borrowing more affordable, and that helps people buy houses and increases the demand for houses. There is this combination of very unique circumstances where people really want more space, and interest rates, mortgage rates are low, which is making borrowing more affordable. Together, those are stimulating demand. With respect to monetary policy, Greg, monetary policy, it's a broad macro instrument, and we really need to look at the needs of the whole economy. The housing market is an important part of the economy. The housing market is built into our projection. When we look at the whole economy, there's still at least 500,000 Canadians who are out of work relative to the employment rate before the pandemic. There's considerable excess supply in the economy. Right now, the economy needs our support, and we are committed to providing the support the economy needs to support recovery and get inflation back to target. With respect to housing, our role particularly focuses on providing information and analysis. As I mentioned, we put out some analysis a couple of weeks ago. We will have more in our financial system review. This analysis should be helpful for Canadians taking decisions. It should be helpful for the financial community and lenders. And it's also helpful for other levels of government, OSFI, that play a role in this market.
Okay, the next and final question is from Greg Bunnell of BNN Bloomberg. Go ahead, Greg.
Yes, Governor, thanks for taking my question. I want to go back to July of last year, which obviously in many ways was a different time, but you did have a message for Canadians then. You said, if you've got a mortgage or if you're considering making a major purchase or you're a business and you're considering making an investment, you can be confident that rates will be low for a long time. Given today's NPR, given today's outlook for the economy, if you had to update that message to Canadians, what would the update be?
Greg, my message to Canadians would be, I'd summarize it in 3 words: progress, time, and commitment. We're making good progress. Canadians and Canadian businesses have been impressively resilient to the pandemic. The outlook is looking better. Vaccines are rolling out, and there are brighter days ahead. And reflecting that, we have revised up our outlook. But second, time. It is still going to take some time to get to a complete recovery. This third wave is a setback. It is straining healthcare systems in part of the country. It will unfortunately particularly affect, once again, the hardest hit sectors and then the workers in those sectors. Important parts of the economy remain very weak. We have too many unemployed Canadians in this country. The third commitment, the Bank of Canada is committed to supporting Canadians and Canadian businesses through the full length of the recovery. And those were really the central considerations in our decision today to adjust our quantitative easing program and maintain the exceptional monetary stimulus.
Just as a follow-up, I want to say, when I saw the decision today, when I saw the inflation expectations being pulled forward to perhaps hitting target by next year instead of 2023, just that idea of when you said you can be confident rates will be low for a long time, it felt like to me that statement, that outlook has changed, that sort of some people have taken as a low rate guarantee. Do you feel that it has shifted?
Our commitment from the beginning, Greg, has been with respect to our forward guidance, which, as I indicated earlier, it is an outcome-based forward guidance. We are committed to hold the policy rate at the effective lower bound until slack is absorbed to sustainably achieve our 2% inflation target. What we're doing, the good news today is that economy has proven resilient. The outlook, vaccines are rolling out. The outlook is better. We think we're going to get back to a complete recovery sooner than we thought before. That's a good news story. That's what everybody wants. We've updated Canadians to reflect our latest outlook.
Thank you very much. Thank you, Governor. That concludes today's press conference.
And so we have been unusually clear about the future path for interest rates. If you've got a mortgage or if you're considering to make a major purchase or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time. Low interest rates make spending and investment more affordable, and spending and investment will support the recovery. That would be our message to Canadians.